Investing isn't just about stocks and bonds. The wealthy have long understood the power of diversifying into commodities. But how exactly do they do it? And what strategies do they use? In this video, we'll dive deep into the world of investment strategies, focusing on how the affluent are investing in commodities across the globe. Traditional investment strategies focus on diversifying a portfolio across various asset classes like stocks, bonds, and cash to manage risk and achieve steady returns. These strategies often rely on a long-term, buy-and-hold approach, where investors choose assets based on their risk tolerance and financial goals, holding on to them through market ups and downs. Stocks are typically chosen for their potential for higher returns, while bonds offer stability and income. The emphasis is on minimizing risk through diversification and maintaining a balanced portfolio over time, rather than frequently buying and selling to capitalize on short-term market movement. Commodities are any useful or valuable things, especially something that is bought and sold. Commodities such as gold, oil, and agricultural products play a crucial role in a diversified portfolio by providing a hedge against inflation and market volatility. Unlike stocks and bonds, commodities often move independently of traditional financial markets, offering a way to reduce overall portfolio risk. Their value is influenced by supply and demand dynamics, geopolitical events, and economic shifts, making them a valuable asset class for balancing risk and enhancing returns. Including commodities in a portfolio can help investors protect their wealth during periods of economic uncertainty and benefit from price changes driven by global trends. Commodities are typically divided into two main categories: hard and soft commodities. Hard commodities are natural resources that must be mined or extracted, such as gold, silver, and oil. These are often used as raw materials in industrial processes and are considered valuable for their role as inflation hedges and store of value. On the other hand, soft commodities are agricultural products or livestock, like wheat, coffee, and cattle. These are primarily used for consumption and are more sensitive to weather conditions, seasonal cycles, and agricultural practices. Both types of commodities can offer diversification benefits to a portfolio, with hard commodities often providing stability during economic downturns and soft commodities offering exposure to global supply and demand shifts. Commodities are traded through various methods, including futures contracts, spot markets, and exchange-traded funds, ETFs. Futures contracts are agreements to buy or sell a specific amount of a commodity at a predetermined price on a set date in the future, allowing traders to hedge against price fluctuations or speculate on future prices. The spot market involves the immediate purchase or sale of commodities for cash, with delivery taking place right away, reflecting the current market price. ETFs provide an accessible way for investors to gain exposure to commodities without directly owning them, as these funds track the price of a commodity or a basket of commodities, offering a simpler and more liquid investment option. Commodity prices are influenced by several factors, including geopolitical events, supply and demand, inflation, and currency fluctuations. Geopolitical events, such as conflicts or trade disputes, can disrupt supply chains and affect availability, leading to price changes. Supply and demand dynamics are fundamental, with prices rising when demand exceeds supply or falling when supply outstrips demand. Inflation affects commodity prices as rising costs of goods and services typically increase the value of commodities, which are seen as a hedge against inflation. Currency fluctuations also impact prices, especially since commodities are often priced in US dollars. A stronger dollar can make commodities more expensive for holders of other currencies, potentially reducing demand and lowering prices. The wealthy often invest in commodities to diversify their portfolios and hedge against inflation and economic instability. They typically access commodities through futures contracts, allowing them to speculate on price movements without holding the physical asset. Many also invest in commodity-focused exchange-traded funds, ETFs, or mutual funds, which provide exposure to a broad range of commodities with greater liquidity and lower transaction costs. Additionally, some wealthy investors may acquire direct ownership of physical commodities like gold or real estate holdings rich in natural resources, offering both a tangible asset and a potential hedge against market volatility. Physical ownership of commodities, such as gold bars, silver coins, or barrels of oil, allows investors to have direct control over their assets, which can provide a sense of security during times of economic uncertainty. However, this form of investment also comes with significant security and storage challenges. Physical commodities require secure storage facilities to protect against theft, loss, and environmental damage, which can incur additional costs. Proper insurance is also needed to safeguard these investments. Additionally, the logistics of transporting and storing large quantities of physical commodities can be complex and costly, making this form of investment less accessible for some investors. Wealthy investors often use futures contracts and options to speculate on or hedge their investments in commodity. Futures contracts allow them to agree to buy or sell a specific amount of a commodity at a predetermined price on a future date, enabling them to profit from price movements without holding the physical asset. This can be used to speculate on rising or falling prices. Options provide the right, but not the obligation, to buy or sell a commodity at a specific price within a set time frame, offering a way to hedge against adverse price movements while limiting potential losses. These financial instruments allow wealthy investors to manage risk and potentially enhance returns by capitalizing on price volatility in the commodities market. Private equity in commodities. High net worth individuals often invest in private equity funds focused on commodity-producing companies or infrastructure projects. Hedge funds that specialize in commodities focus on investing in physical goods like oil, gold, and agricultural products, or financial instruments tied to these assets, such as futures and options. These funds aim to generate returns by leveraging the price volatility and unique market dynamics of commodities, often employing complex trading strategies to maximize profits or manage risk. They may also use hedging techniques to protect against price fluctuations or to speculate on market trends. Given their specialized expertise and access to sophisticated trading tools, commodity-focused hedge funds can provide investors with exposure to a diverse range of commodities, potentially offering high returns along with significant risk. Global diversification. Wealthy investors often diversify their commodity holdings across different regions to mitigate geopolitical risks. Examples include investing in oil in the Middle East, gold in Australia, and agricultural products in South America. Commodities are often more volatile than stocks and bonds due to their sensitivity to supply and demand factors, geopolitical events, and natural disasters. For instance, oil prices experienced sharp swings during the 1973 oil crisis when an embargo led to a fourfold increase in prices. Similarly, gold prices surged dramatically during the 2008 financial crisis as investors sought safe havens. More recently, agricultural commodities like wheat saw spikes following the 2022 Russian invasion of Ukraine. These examples highlight how external factors can cause rapid and unpredictable changes in commodity prices, making them more volatile than traditional equities or fixed income securities. Commodities like gold are often used to protect against inflation, but not all commodities serve this purpose equally. Physical commodities and certain futures contracts can be less liquid than other investments, meaning they might not be easily sold or converted to cash without significant price concession. This lack of liquidity can be risky, especially during market stress or economic downturns, when finding buyers becomes challenging. For example, during the 2008 financial crisis, some commodity markets froze, making it difficult for investors to exit positions quickly. Similarly, physical commodities like real estate or rare metals can take time to sell, which may pose challenges if immediate funds are needed. This illiquidity adds an extra layer of risk to investing in these assets. Wealthy investors increasingly balance profitability with environmental and social governance (ESG) considerations when investing in commodities like oil or palm oil. They recognize the financial risks associated with unsustainable practices such as potential regulatory penalties, reputational damage, and market shifts towards greener alternatives. As a result, many opt to invest in companies that demonstrate a commitment to reducing environmental harm and improving social practices, even if it means accepting slightly lower returns. This approach allows them to manage risk, align with global sustainability trends, and contribute positively to society while still pursuing profitability. Retail investors can access commodities by investing in ETFs, mutual funds, or commodity-related stock. ETFs and mutual funds provide exposure to a basket of commodities or commodity-focused companies, offering diversification and easier entry compared to directly purchasing physical commodities or futures. Commodity-related stocks, such as those in mining or energy sectors, allow investors to gain indirect exposure to commodity price movements through the performance of companies involved in their production and distribution. These vehicles make it simpler for retail investors to participate in the commodities market without the complexities of direct ownership. For conservative investors, incorporating a small allocation to gold or broad commodity ETFs can add stability and hedge against inflation. Moderate risk takers might diversify further with energy or agricultural commodities through ETFs or mutual funds. Aggressive investors can consider direct exposure to individual commodities or futures contracts, though these come with higher volatility. Balancing commodities with stocks, bonds, and other assets helps spread risk and enhances overall portfolio resilience. Adjusting the allocation based on risk tolerance and market outlook is key to effective diversification. Emerging commodities like lithium and rare earth metals have gained prominence due to their critical role in technology and renewable energy sectors. Lithium, essential for batteries in electric vehicles, and rare earth metals, used in electronics and clean energy technologies, are experiencing increased demand as the world shifts towards sustainability. This demand has spurred interest in blockchain technology for trading commodities, allowing for more transparent and efficient transactions. The concept of tokenized assets, where physical commodities are represented digitally, is also gaining traction, offering new ways to invest in and trade these resources. Global moves towards sustainability are reshaping commodity markets, with investments flowing into green energy and ethically sourced materials. This shift is driving innovation and changing the landscape of resource extraction and trading, as companies and investors prioritize environmental and social responsibility alongside profitability. Commodities are a powerful tool in the investment arsenal of the wealthy, but they're not just for billionaires. By understanding the strategies and risks involved, you too can leverage commodities to protect and grow your wealth. Use these pointers and information to help you plan and incorporate commodities into your investment strategy. If you found this video helpful, be sure to hit the like button and subscribe to the channel. Until next time, this has been The Long and Short.